Hey everybody, my name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive technology investing for a broad audience of retail and institutional investors across the globe. Today we're going to talk about an interesting platform that allows you to generate rental income without buying a home. Now, for those of you that have been homeowners, you understand that owning a home is nice because you have a place to live, but it also brings about a lot of costs that you don't really think about until you actually have to deal with them, not to mention hassle and all sorts of stuff. So when we look at our portfolio of assets, everybody should look at this holistically. And for most Americans that have a home, their home equity makes up a decent chunk of their net worth. Now, when we look at assets such as realty, these fall into an alternative asset class allocation. So platforms that are being developed these days have really expanded your options. So you can now own farmland, you can own art by Masterworks, Vinovest lets you own wine. There's a new platform coming online now that lets you dabble in private equity. And of course, startups, you can get involved with those through funds or through some institutions that let accredited investors invest alongside VCs. Then you have gold, which arguably the new gold is Bitcoin. We haven't listed Bitcoin as an alternative asset, but it certainly could be considered one. And then, of course, realty, probably the most popular alternative asset since so many people own homes. Now, to get realty exposure, that's how you've traditionally had to do that. Either buy a home, or if you want to live in your home, maybe you'll buy a second home and generate some passive income from that property. There's also these real estate investment trusts that you can invest in. Some are quite good. We're holding 3 in our dividend growth investing strategy. They're all commercial property REITs, but you can also find residential REITs like, is it Mid-America? The ticker's MAA. So I think they have, hundreds of apartment complexes and around 100,000 units, though MAA's yield lately has been quite low at 2%. So realty has traditionally been, you could say, risky, because if you buy a house, you're kind of putting all your eggs in one basket. That neighborhood, that district, that state, there's a lot of concentration there. So what would be nice is if you could invest in properties more like having a portfolio of rental properties. Now, the company we're going to talk about today, called Arrived Homes, lets you do that. And you can see here some of the houses on their platform. The way that it works is like this. So you can invest as little as $100 in a property. And what Arrive does, they identify a property, and then they'll purchase that with a 70% interest-only mortgage, and then a commitment from investors. Once they have those two components, they purchase the house, they rent out properties using 2-year leases. It's quite surprising that the average yield in the United States from rental income, let's say gross yield, if you take the property price and divide that by the rent, somewhere around 7%. That's pretty high. And then Arrived plans to hold these homes around 5 to 7 years, which seems a bit risky, and we'll talk about why. What that translates into for investors is a quarterly payment that usually equates to between 3.2% and 7.2% annual return on your investment. And if you want out, you can redeem shares on a quarterly basis after you've held them for 6 months. And when we went on the platform to check out their offerings, they just have a few homes that are available. So there seems to be a lot of demand. Now, when we look at the price components, so the total purchase price isn't just about the property. They also allocate money for property improvements and cash reserves. So that's typically 2% of the home value. There's closing costs that need to be paid. And then there's this one-time service fee, which is one of the ways that they make money. Now, we looked up a sample property just to get an idea of how this works. This is the Lovejoy. I believe it's somewhere in Alabama, built in 2020. They're selling it for $293,000 with the monthly rent of $1,895. That's about a 7% yield. And then it's seeking a tenant at the moment. And here is the breakdown of the total property amount compared to the property purchase price. So you see here that they've put the cash reserves allocation, the closing costs, and that annual service fee. That's about 5.4% of the property purchase price. When you think about that, it's not horribly bad because a realtor will take, somewhere in the range of 3 to 5%. And then we have the property loan amount, financing again 70% of the property's value, and the interest rate at 3.875%. And then what also isn't noted here is an asset management fee, which works out to about 44 basis points, so 0.44% of the income that comes in from the property. So they'll make a payment, I think it's on a quarterly basis. So that's another avenue of revenues for Arrived. So if you take the property loan amount, you add to that the equity raised from investors, and then you get the total property amount. Now, it's an interesting platform, but there are some concerns. So for example, that property that we just looked at, here's the Zillow home price trends for that zip code that property is located in. Look at that spike. So from 2021 to 2022, in that single year, the price of the average property price in that zip code jumped 28%. Well, guess what? They can fall 28% as well. And with 70% of the home's property being contained within a mortgage, that means if the home's property price falls 30%, that soon the loan will be underwater. So liquidating the house won't be able to pay back the loan. In that case, it would seem that Arrived would extend their 5 to 7 year holding period. So that needs to be considered. And the fact that they're only taking out interest-only mortgages, that's also a concern. So they never actually gain any home equity value over time. Of course, that's because they're only planning on holding for a short period of time. So the platform is quite interesting. We think every investor ought to have exposure to realty as an asset class. If you don't own a home, maybe you look at REITs like we did, or maybe you'll look at Arrived. Now, if you go on that platform and invest in a single home, you haven't done yourself any favors because you're not utilizing the platform, which lets you reduce property specific risk. Take the money that you want to put into a single property and spread it out over 10 properties. Now, the availability, at least from what we can see on the platform, the selection isn't overly abundant. So I think there were 2 or 3 properties the last time we looked that were available for investors, but they come and go fairly quickly. So you would just have to have some time and patience and then build yourself a portfolio of properties. Now, the added risk, of course, even though you're reducing property specific risk, the added risk that you're taking is the platform itself. As we talked about earlier, what happens if there's a property market crash and Arrived gets put in some difficult positions. So very interesting platform. Do give it a look. Be sure to subscribe to our YouTube channel. If you have any comments, just put them on the video here. We'll answer them, and we'll include the article that we wrote about this firm, which has more detail in it, in the description of the video. Thanks very much for your time.